All right. First of all, welcome to Stock Analysis Friday, or stock market review, I should say. All right. And I also want to wish everybody a happy July 4th tomorrow. Have a great time with your families. All right. So today we're going to talk about the stock market overall. We're going to take a look at the different indexes. Market's kind of treading water right now. We got a few economic reports coming out, including the Fed minutes. So I think they're kind of standing pat right now until those actually release. So in terms of interest rates, I'm still thinking maybe one cut in September. They're kind of leaning that way, regardless of the numbers or not. I still think they're going to do it simply because it's an election year. So we'll see what happens with that. All right, let's jump in and take a look at markets and charts. So let me go over here real quick and just go through some administrational items to begin with. All right, first thing I want to do, of course, is put up the like, subscribe, and share screen. If you get a chance, just give us a like, and you're already subscribed, I'm sure. So that helps the channel out. All right, in terms of risk, there's no guarantees in trading the financial markets. We deal in a realm of probabilities. So you have to use very strict risk control. You always also have to trade with money you can afford to risk, called risk capital. And also know how to do your risk control on each and every trade. So that's super important. I have several books and topics on that as well. Also, too, when we talk about funding your account with money you can afford to risk, if you are an active trader and do a lot of day trading, I would recommend using a prop firm for that, because basically you're not risking your own money. There are a couple subscription fees, but that's it. All right. So, and you get free data. So it's a good way to hone your skills. And then once you get funded by those firms, you have to get funded in order to start earning any money in terms of payouts. But it is a possibility. But, you know, you have evaluation accounts so you can practice your edge. And, you know, basically you're not going to get funded until you're actually good enough to do so. So actually that's a good thing. But if you're interested in that, the one I recommend is Apex. I've got a special link and a discount code you can use for that. I will put that in the chat area so you all have that. But I think it's an excellent place to start. As you can see, the payouts, average monthly compensation to customers since January 2023 is 11 million. You got total compensation to customers since 2022, 182 million. And then total compensation to customers just in the last 90 days, 70 million. So as you can see, payouts are substantial for those that have an edge in the market. So again, great way to do it. You get free data too while you're learning, so you can't beat that. But it is for futures only, not stocks. All right, let's move on here. A couple more things to go over. In the risk control arena, I want to direct you to two books here that I've written on risk control. Trader's Money Management System, published by Wiley Trading a number of years ago, and my newest book, Money Management for Traders, that came out in 2022, actually. And that is a great book as well. And it's basically it's like a cliff notes of everything you need to know about risk control. So it's an easy read, quick implementation into your trading system, and the whole 9 yards. I've got Elliott Wave Techniques Simplified, published by McGraw-Hill, and then The Art of Trading, also published by Wiley as well, coming out this year. Finish the book. It's a great book. It's going to be a long one, about 500 pages, depending on the layout, maybe a little more, maybe a little less, but that is coming out by the end of this year, so you can pre-order that. And I'll put links below for all this stuff. All right, in terms of software, same type of thing. We've been doing this now for 30 years, and this is the software that I've developed and come to trust over those time periods. So we have the ART, OWL, PTF, TLM, and ERI indicators. We got scanners, and we have risk control software as well. All right, let's take a quick look at the markets. Now, I did a bunch of charts on Sunday, and we'll probably take a quick look at some of the live markets today as well. But basically, you know, we're skimming along this ledge here, and I'm going to outline this ledge right here. And we're skimming along right here. Not quite in the target zone, but boy, I'll tell you, close enough that if it ended here, it wouldn't surprise me. Okay, so kind of got to be careful in this area. However, all right, my gut feeling on this is that we will get into the target range, because 70% of the time markets do get into that wave 5 target zone. Now, what is a wave 5? Some people may ask. Well, that's part of the Elliott wave. And there are 5 waves in a trend. So at the end of the 5th wave, the trend is over. And then it reverses direction. We start a new trend in the opposite direction. So we're kind of getting close. Now, this wave 5 target zone is a Fibonacci extension. And that's a form of technical analysis that's pretty much commonly used. And basically, the way we do it is we anchor it on wave 2 and then anchor it on 3 and then 4. And that gives us the wave 5. The key thing is that I'm going all the way back to 2009 when I'm doing these anchoring points. So this is a long-term, pretty significant level here. So once we get into this wave 5 target zone, then of course we got to look for some serious selling to come in. And at that particular point, we may have the end of the bull market. So when is that going to happen? Well, that's the wild card. That's hard to say exactly. But I would imagine probably sometime maybe after the election, we could see it. Could it end tomorrow? Sure. But something would have to come along to really throw off the apple cart, so to speak. And I don't see anything right now coming that way. Interest rates will probably get cut, I think, in September. That's my guess. All right. And that's all it is a guess. But I think that because if you start leaning towards listening to what the Fed is saying and kind of the mood of things, the fact that it's an election year, I think they'll probably cut it one more time in September in order to keep these markets at least kind of somewhat stable going into the election. So if that's the case, I would expect it then to get up into this wave 5 target zone. Now, when we get up to the wave 5 target zone on your longer charts, like the weekly charts, you're really looking at an area where it's at top of a major target as well, called a wave 3. All right. So there are waves inside waves. So these are the waves inside the longer term time frames. But in any case, that means we're going to go into a bear market. So after wave 5 target has been reached, the market produces some selling, gets confirmed that we're now in a downtrend. It's going to be a bear market at that point, lasting for a year or two, maybe 2 years. And that's going to be a big one with a drop around probably anywhere from 40 to 60%, just about across the board. I don't think we're quite there yet. If you also look, and we'll look at the other indexes, they're not in their target zones either quite yet. So I think we have more room up. But I do think it would be a good idea to get with your financial advisor or whoever manages your money and come up with a game plan if the market starts to slide into a bear market. And of course, you'll probably have a recession with that. Housing will get kicked in the butt as well. So you'll have some serious financial changes at that point. So you may want to get with them and talk with them as well. I don't want to be gloom and doom here, but I think that's what the reality is kind of pointing to later this year going into 2025. Until then, all right, I do think we're going to see some more highs in the market. Now, I put on this chart here some support levels at various places. So the one that's closest is this one anchored off this pullback bottom that occurred earlier in the spring here. And that's 37,611.55. So if we stay above there, I think we'll just trickle on up in here. If we take that out, then we got to worry about this support level, which is a more significant one that was put in basically in October of 2023. And that's 32,537. All right. And if we take that out, then that's not a good sign. I would say if we take this support level here out, we're probably looking at that particular point of sliding into a bear market. And I don't think we'd return and head back into the wave 5 target. If we go back below here, then that's is about as certain as you possibly can be in the markets that we are now in a bear market. So those are levels that we're kind of watching. And as long as we stay above the short-term level, I think we're kind of on our way to the target zone. All right, so that's one chart. And then also, too, what I noticed here is we got, this is the 60-minute chart of the Dow once again. And on the Dow here, this every price bar represents an hour. So this is kind of what they consider a shorter-term outlook on a market. And on the Dow Jones Industrial Average here, we had a pennant, okay? So we're kind of like in this zone here, and this was as of Sunday, where we're looking for a breakout of that pennant. And we have one of our indicators down here that has a 75% probability rate, basically is indicating higher highs. So I would imagine we're going to poke back up to the upside and then head on into the target at some point pretty soon. All right, switching to housing. Now, if anybody has any questions on the markets, let me know. All right, we'll also take a look at some of the other indexes in just a bit. Now, I want to talk a little bit about mortgage applications. All right, anybody out here in the mortgage industry, just out of curiosity? Going once, going twice. All right, if you are, all right, I know you're having a tough time these days because basically the mortgage business in terms of writing mortgages, all right, is as bad as it was during the last recession, major recession in housing in 1995. I mean, that's pretty bad. All right, so basically what's interesting in this housing market is the prices have remained up, but the transactions are so low. In other words, not many things are selling, that you're having these type of implications. You know, real estate agents having a tough time because they make money on transactional business, and so do mortgage brokers. So this is a chart that kind of really comes out and says it all, right? All right, now if we go back to the S&P 500, this is another index that we watch very closely. And as you can see, we have some targets sitting up in here and here that have not been reached. So again, if we look across the broad bases of indexes, they're close, but they are not yet in their target zone. So that's why I think we got some more movement up to the upside before we switch over into this bear market situation. And notice here that we have a PTF that's green, even on the S&P 500, indicating more highs are coming. Same thing with the NASDAQ. And the NASDAQ here, again, the green PTF on the center chart, and nowhere near its target zone. And, you know, the big boys are in here and then the S&P. So they're going to drive this market up, I think, into that target zone. So if you're trading a lot of these and you have a lot of these, I would, again, trail your stop, especially if they're trading items that you're using, even if you've been in them for a while. Keep those stops close so you can lock in profits. And if you're investing in this stuff, again, talk to your financial advisor, come up with some type of game plan in case the market reverses. You know, there's inverse ETFs. There's a lot of hedging you can do without actually selling some of your long-term holdings and therefore getting a tax situation when you do so. So talk to them, find out what the best plan is for you. All right, now the KShiller index versus the CPI. This is a great chart. I love this chart, and I cover it every week. We go back 50 years to the 1970s, way back here, and here's where we are currently up here. All right, so if we go back long enough, you'll notice how close the red and black lines have been. And this is, the red line is the KShiller, and the black line is the CPI. So the KShiller basically is an index that measures home prices, the average home prices in the United States. All right. So real estate, you got to remember, real estate is very local. What's happening in your neck of the woods may not be exactly happening in somebody else's. So you got to keep that in mind. But overall, this is an average. The CPI, again, it measures inflation. It's the consumer price index. There's some items that are left out, I think energy and some things. So it's not exactly covering every item. But in any case, it's a measure that they use. And what we've noticed here is if you bought a house going back 50 years, the house has increased in value above the CPI. So it's been a good hedge against inflation and therefore a good investment. And so that's why home ownership has been such a crucial and integral part of people's prosperity in the United States for quite some time. You buy a house, you got a place to live, raise your family, but in addition, you've got an investment that keeps up with inflation. All right, so that's a good thing. All right, there's times, however, where we have these bubbles, okay? And the biggest one recently we had that corrected was the financial crisis. And if you remember, that had to do with all the, basically the securitization of mortgages, and they would create these Wall Street funds where you could buy these mortgages, and they were packaging them like crazy, and everybody qualified. You know, if you could breathe, you could get a mortgage back then. There was no income checks. You have a decent credit, you had a collateral piece of property, you basically got the mortgage. Problem is that then they had a whole bunch of people that were in houses and in mortgages that really couldn't afford it. And during the first signs of weakness, i.e. recession, of course, that's when the bottom falls out. And that's exactly what happened here. And then the Lehman Brothers went under. You remember all the big banks that got very, very long on those things, got killed. All right. And then basically it came down. They lowered rates. The recession ended, and the rates were so low. People had jobs once again, and housing went up. Then you had COVID, and you had a lot of stimulated money coming in, but also they even lowered rates again. People came out from the cities to live in the suburbs, and you could work at home. And so there was a big demand on housing. And here we sit right here. All right. So notice how big, all right, this particular distance is from the CPI, the Case-Shiller, compared to what it was back during the financial crisis, like twice, right? Huge. That's not a good sign, guys. All right. Now you can see where the CPI has jumped up when inflation came up, but so did houses. So it's still the same distance away. So somehow those lines have got to get closer together. So you are either going to have hyperinflation or you're going to have a tremendous dip in home prices. Both scenarios are not good in any case. I think probably we'll see home prices come down simply because people can't afford a job. You know, incomes are not going up, all right, in terms of anywhere near the price of homes and to keep up with inflation. So, you know, if you got hyperinflation, forget it. All right, that's just going to wipe everybody out pretty much. So I would think home prices are going to come down, and I think they're going to come down substantially, you know, anywhere from 40 to 50% in order to get back in line with the average Case-Shiller versus the CPI. So I think you got to, you know, if you're a realist, you got to kind of be thinking that. Now, you'll also hear during these times that, you know, it's always different. Every bubble, they always say that. Oh, it's different this time. I remember the tech bubble back in 2000. You guys remember that? You know, technology's here. You have, you know, times are different now. All right. And of course, then you had the bust there. But, you know, bubbles can last a long time. They can last years before they actually get bursted, so to speak. So, you know, keep that in mind. I think we're on borrowed time on both the stock market and also the housing market. Now, inventory did go up this year, all right, which was a good sign. They wanted to get some inventory up in order to stabilize, maybe even drop home prices, but it's not up enough. That's the problem. So it has come up, but and it grew 35%, but it still has not been enough in some areas to decrease the prices. So more supply than demand, you'll have prices come down, right? Gives the buyers more choices. So in places like, you know, California, this is a great one for California. Yeah, we're up in inventory, but not enough to lower the prices. So this chart basically is calling for another 20 to 30% before prices drop meaningfully. Now in Texas and certain things, and even Florida, you're seeing prices starting to come down. All right, California, I don't think so quite yet, but that'll be the next one I think that does. All right. Active housing inventory for sale compared to pre-pandemic levels, the shift between 2019 and May 2024. This is kind of a cool chart, okay? So basically, the higher the number, okay, the more prices are going to come down. I don't see very high numbers there, right? They're all negative. So that's why housing, the inventory is nowhere near what it was, all right, back in 2019. Now, Texas, we're up too. And notice we're up a little bit here and prices have come down. Here, we're down only 5. California, minus 39, minus 47. Again, this is inventory, okay? So a negative number means there's not much inventory. It's down compared to 2019. Up from last year, yes, but nowhere near the levels as it was 2019. So, the higher the negative number here, all right, the more you're going to see prices maintain their higher levels, if not go up. All right, check out Maine, way up here. Check this out, 60%. I think that's the highest one. 58% down in here. Incredible, right? All right, so anyway, that kind of gives you an overview of what's going on in the last, 5 years? All right, kind of interesting. All right, on the interest rate situation, as of over the weekend, 30-year fixed rate was at 7. All right, down a little bit, 0.08. 15 years at 6.47. So mortgages are right around 7. The ARMs are about 6.59. Be careful of the ARMs, okay, because they will adjust their interest rates, of course. And I think probably they're getting ready to start offering those. From what I hear, from what I read, the scuttlebutt is that they're going to start offering those a lot more for folks in order to refinance. They're going to make the qualifications easier, like they did, sound familiar, before the financial crisis. And they're doing this because everybody's putting everything on their credit cards, and the credit card debt is just taking off because of inflation. So wages have maintained levels, but inflation has really hurt people. So in order for them to maintain their lifestyle, they've either had to get another job or even put money on their credit cards in order to sustain themselves. And so now what their government data is showing is that credit card debt is at an all-time high. And it's, what is it, 30% annual? So people, they're worried about that. And so they're going to make these ARMs available that you can get. There's a lot of equity out there in the homes because the prices are so high. So they're going to push these ARMs in order for people to pay off their credit cards with a lower rate mortgage called the ARM. Problem is that now they've tied themselves up for more debt, and they don't own their house free and clear, or don't own that equity free and clear. And if the real estate market tumbles, then they're going to be underwater. So I'm not so sure that's such a great idea, but I think they're going to peddle that. All right, so just kind of keep that in mind. All right, so any questions on here? We're only got a couple more minutes. I thought I'd take a look at Bitcoin real quick here and see what's going on with the Bitcoin. I don't think Bitcoin's done coming down. All right, we were hoping it was going to go up and make a new high. My target now for Bitcoin is 55,271 to 43,694 before it's all over. And then we should see more highs. So this is now a major wave for pullback. This is our target. And the interesting thing is markets are markets. So we were hoping this was a bottom here, but looks like 3, A, B, C, Elliott Wave 4 target, and then Wave 5. So if you don't mind sitting through this sell-off here, which could last, another few months, depends how long it takes to get down there, then you should be okay long term. If you're looking to buy more, I think you're going to have a great opportunity here to buy more in this area here. All right. And if you bought way down here, you want to sell out here and see how far down it goes, then buy back in here. That's a possibility. That's basically trading, right? But I do expect more highs, all-time highs on this. But unfortunately, that's going to have to be shelved until we finish this correction. So I think Bitcoin is definitely coming down some more. And I think you're also going to see that as well in GBTC, which is the ETF for Bitcoin. And you're seeing that come down too as well. All right. And so all these markets are kind of heading on down. I got the 200-day moving average right here. So just kind of checking that out. All right. So that's that one. And let's take a quick look at USO real quick. All right. So USO is coming off its bottom. It had a pennant drawn on the weekly chart on the far right. And we're recommending a long position on here. Our target's about 100 on oil, all the way up to, 125. And it looks like we've got a major bottom that was put in oil back in 2023. So we've been long for recommending a long position for quite some time on that. And once we break out of this wedge that we're in here, or pennant, then we should accelerate pretty quickly, I think. So I'm thinking that looks pretty good. I want to take a look at UNG, which is natural gas. This kind of broke out and then pulled back, and we're still seeing it pull back. Still got a green PTF here. Let me just enlarge this. Not unusual to get a big pullback like this. And this is, what forms at times double bottoms. We're thinking this is a major bottom here. Of course, it may not be, but that's kind of the thought right now. So we're hopeful we'll see some more pressure back to the upside before that bottom takes out. So I'm not recommending it right now. All right, if you got in earlier, just have your stop way at the bottom. That's why we always say put your stops at the bottom. But let's for new people not in it yet, let's wait and see a turnaround on this, because it's definitely going down into its classic. If this is a wave one, wave two can retrace 100%, not the normal fib. And you can see we're blowing through the fib over here. So I kind of think we're going to get a major retracement on that one. Let's see what else. Okay, TLT bonds. All right, so the bonds, all right, have been kind of a little bit fluctuating here. Long term, the bottom's not in yet. You may see a little bit of movement up for a retracement, or we may have gotten it, but I'm not that excited about the bonds in terms of a long-term play right now. All right, I'd stay out of that. All right, well, I think that's it for today. Trying to think of anything else. Oh, silver. Let's take a look at silver and gold before we call it a day. Silver, okay. So silver, it was pulling back a little bit. We had a target here for the pullback, and then we had a bounce off that. I'm kind of taking a look here to see if that pullback pressure is over. I think it is, okay. Looks like all the PTFs now are turning green that we watch for that, and we are having a breakout. Notice a breakout from the pennant back on the weekly chart. That was huge. So I think probably we're heading back up on silver. I think you'll do pretty well on this if you're long. If you are long here, you could probably count on taking out this high at some point. You may have one more, a little bit more channeling here before it breaks out. I kind of want to make sure that the owl here turns green before definitively saying that the correction is for sure over. I mean, it certainly seems like it is, but I need a few more things to mature to the upside before I'm really to make that call. But I do think overall silver is a pretty good play long term, because even if it came back down, you're only talking about probably going back into this target zone one more time. But in any case, it looks pretty good from a long-term stance. Gold, all right. I actually like silver better than I like gold. All right, gold, probably some more highs coming on gold, but we're kind of getting a little toppy on it here. Okay, but I think probably more movement to the upside is underway. So I think if you're holding gold, you'll probably see some higher prices. But I think probably, like I said, I think a while back, my target was around 240 for gold, and we're at 218. So I think we're kind of getting up there, and we'll see what happens on that short term. All right, so that's kind of where we're at there. All right, so let me just see if there's anything here. Yeah, happy 4th of July to everybody there as well. Okay, for sure. All right, let's see. Small mortgage, that's a good thing. Okay, Marone, how are you? All right, great. I don't see any questions I need to answer, so I guess we'll go ahead and tie it up there. So overall, just a quick summary. I think the markets, including housing, will stay pretty firm here, at least until the election time. All right, unless something comes out of left field. That's the wild card. We are close enough to some of these targets that if something came out of left field, that it very well may end the bull market. That's possible, but I don't think so. I think we're going to get up into those targets, and I don't think you're going to have to worry about a major sell-off until the end of the year. But then I think you have to worry about it. So I think probably short-term we're good. Towards the end of this year, bleeding over to 2025, I'm predicting a major recession and bear market in both housing and stocks at that point. All right. Now, if you have any individual stocks, we will be back here on Friday for Stock Analysis Friday. So don't forget that. Okay. So we'll be back for that. All right. Have a great week, and we will see you next week. Have a great July 4th. Bye-bye.